Triangles are widely recognized as one of the most common chart patterns among traders. They serve as visual representations depicting the ongoing struggle between buyers and sellers in the market. These patterns assume a vital role in facilitating decision-making processes, assisting traders in determining whether to initiate buying or selling positions during market trends, consolidation, or reversal phases. First, let's introduce the basic principles of demand and supply that will help us better understand the battle between sellers and buyers in the market. Demand and supply examine how the interactions between buyers and sellers determine the price of an asset. The fluctuations in the price, displayed on the board, indicate these interactions. At this point, we need to explain the law of demand. The law of demand states that when prices rise, buyers are willing to buy less, and when prices drop, they are willing to buy more. Applying this concept to chart patterns, in its simplest form, a triangle pattern indicates a decrease in interest in an asset from both buyers and sellers. Let's examine the bottom line of the triangle, referred to as the lower trend line. This line is known as the demand line, and serves as a support level on the chart. During this phase, the number of buyers surpasses the number of sellers, resulting in an upward movement in the stock price. On the other hand, the top line of the triangle is called the supply line, and indicates the overbought condition in the market. It signifies the point where investors begin to sell their shares and realize profits. By analyzing the formation of this pattern, we can predict the price movement. If the buyers surpass the supply line and push the price to new highs, it indicates that they have won the battle. On the other hand, if sellers break through the demand area and lower the price of the asset, they emerge as the winners. Before delving into the different types of triangles, it is essential to address the second fundamental aspect of mastering the triangle strategy: the breakout momentum. This strategy involves identifying levels or areas where prices have failed to move beyond. When examining the triangle formation, we can pinpoint the demand and supply levels that we discussed in the previous slides. Once these areas are identified, we must wait for the price to surpass these levels to potentially profit from the movement. Here are some tips that will assist you in trading triangle breakout strategies. Firstly, wait for the price to consolidate until you can draw a line connecting the support and supply levels. Establish your entry and exit criteria based on the breakout levels. For an upward breakout, you may consider placing a buy order slightly above the supply level. Conversely, for a downward breakout, you would set a sell order slightly below the demand level. Both orders should be placed near the consolidation area. Here's another valuable tip for you. Watch out for the squeeze area, where buyers and sellers engage in low momentum trading, awaiting a potential breakout. Once you've identified the squeeze area, keep an eye out for a powerful candlestick that confirms the breakout. If you prefer a more aggressive trading approach, you can enter the trade within the squeeze area, or alternatively, being more patient, you can wait for the breakout to occur. Remember to determine your stop loss and take profit levels to manage risk and potential gains. Now that we have a grasp of the basics fundamentals to improve our decision-making skills, let's explore the types of triangle patterns that can occur in any market and any time frames. During my journey, I thought it would be helpful to keep a trading journal to record all my trades. As I delved into analyzing the patterns, I discovered various approaches to implementing the triangle strategy. Through careful analysis and observation, I have come to understand that triangles, a common pattern in technical analysis, can manifest themselves in different market conditions. You can observe the identical consolidation pattern here, which can indicate either a continuation of the current trend or a potential reversal. In my opinion, the most effective approach to figure out if a trend will last or not is to patiently await the occurrence of a breakout momentum. This event can either validate the ongoing trend or potentially signal the initiation of a reversal phase. Let's take a closer look at the descending triangle chart pattern. This pattern is pretty interesting because it can actually serve as both a continuation and reversal pattern, depending on a few key factors. When we consider the descending triangle as a continuation pattern, it's important to look at the previous price trend. This trend could have been either bullish, meaning the prices were going up, or bearish, meaning the prices were going down. If the breakout from the triangle happens in the same direction as the previous trend, it suggests that the trend is likely to continue. On the flip side, the descending triangle can also indicate a potential trend reversal. This means that the previous trend might lose its strength and start moving in the opposite direction. If the breakout occurs in the opposite direction of the previous trend, it could cause a significant shift in market sentiment. This can lead to the emergence of a new trend in the opposite direction. To really understand this pattern, it's important to know that the descending triangle has two main lines, a horizontal support line and a downward sloping resistance line. The support line represents a price level where buyers have historically shown interest, while the resistance line shows a level where sellers have put pressure on the prices. As the pattern develops, the price consolidates within the triangle, which means it doesn't move much and becomes less volatile. One more thing to consider is the volume of trading. By looking at the volume, we can confirm if the pattern is valid. Typically, the volume tends to decrease during the consolidation phase of the descending triangle and then increase when the breakout happens. This increase in volume supports the significance of the pattern. By understanding all these elements of the descending triangle, including the previous trend, breakout direction, support and resistance lines, and volume, we can gain valuable insights into what might happen next in the price movement. Remember that trading comes with risks, so it's super important to really understand the strategy and practice it with small amounts, or in a simulated environment, before you go all in with your hard-earned cash. Keep in mind that no trading strategy is foolproof, so always be ready to tweak and adjust it as needed. Oh, and here's one last tip for you. Find that one sweet setup that can pay the bills and totally change your life. Stay persistent and don't give up. I hope this video helped you level up your trading knowledge. Don't forget to give it a thumbs up and subscribe to our channel. Let's grow our community and help each other out. See you in the next video.